Welcome back to Financial Literacy from Scratch. Today, we're tackling a big question. Where should you keep your money? For many people, a bank account is just a card they swipe or a place their salary lands. But once you dig deeper, you realize that the kind of account you choose, and even the bank you choose, can make a huge difference in your financial life. Checking, savings, online versus traditional banks. At first it sounds complicated, but don't worry. Once you understand the basics, you'll see it's actually pretty simple. And by the end of this video, you'll know how to pick the best setup for your money. Part 1. Checking versus savings accounts. Let's start with the foundation. Checking accounts versus savings accounts. A checking account is your everyday money hub. It's where your paycheck usually gets deposited. It's the account you use to pay bills, shop online, and swipe your debit card. Think of it as your wallet in digital form. Money flows in, money flows out. A savings account, on the other hand, is not for everyday spending. It's designed for money you want to set aside. You earn some interest, not huge, but better than nothing. It's your first step toward building an emergency fund or saving for goals. Here's a simple way to picture it. Checking is your day-to-day backpack, while savings is your locked treasure chest. Now, some people make a big mistake. They mix everything in checking. The problem? When your spending and saving are in the same pot, it's too easy to overspend. That's why keeping these two accounts separate is one of the smartest moves you can make. Part 2. How to choose the right bank. Okay, so you know the types. But where should you actually open your account? Not all banks are created equal. Some are friendly, some are fee traps. Here's what to look at. Fees. Does the bank charge you just for holding an account? Monthly maintenance fees, overdraft charges, minimum balance requirements. These can quietly eat away at your money. Security. In the US, you want FDIC insurance, which protects deposits up to $250,000. In Canada, it's CDIC insurance, which covers $100,000. Always make sure your money is protected. Convenience. How easy is it to access your money? Does the bank have nearby ATMs, a good mobile app, 24/7 customer support? The best bank is not always the biggest or most famous one. It's the one that helps you keep more of your money and makes your financial life easier. Imagine two people, Sarah and Mike. Sarah chose a flashy big-name bank, but pays $15 every month in fees. That's $180 a year gone. For nothing. Mike picked a no-fee online bank and saves that $180, which he puts into his savings account instead. Same income, different choices. And in the long run, Mike is way ahead. Part 3. Avoiding hidden fees. Let's be real. Banks love fees. Here are the most common traps. Monthly maintenance fees if your balance drops below a certain number. Here's one fee that surprises a lot of people. Monthly maintenance fees. Some banks actually charge you just for keeping your account open. But here's the catch. You can often avoid the fee if you keep a certain minimum balance. Example. A big bank might charge you $12 every month unless you always keep at least $1,500 in your checking account. If your balance drops below that, boom, you pay the fee. Now think about it. $12 every month is $144 a year. Money gone for nothing. Tip: if you don't want to waste money, you have two options. Look for banks that offer no-fee accounts. Many online banks and credit unions do this. Or make sure you always keep the required minimum balance. So before opening an account, always check. Is there a monthly fee? And what's the balance requirement to avoid it? Overdraft fees if you spend even $1 more than what's in your account. Another common trap in banking is the overdraft fee. This happens when you spend more money than you actually have in your checking account. Even if it's just by one single dollar, the bank will often step in, cover the transaction, and then charge you a fee for it. For example, imagine you have $50 in your checking account, but you swipe your debit card for $55 at the grocery store. The bank approves the payment, but then hits you with an overdraft fee. usually around $30 to $35. So your $55 purchase just cost you $85 to $90 in total. And it doesn't stop there. If you make multiple transactions while your account is negative, some banks charge you a separate overdraft fee for each one. That can quickly snowball into hundreds of dollars in penalties. How to avoid overdraft fees? Always keep an eye on your balance. Turn off overdraft protection if you'd rather have your card declined than pay a $35 fee. Link your checking to a savings account. That way, money can transfer automatically if you overspend. Or choose a bank that offers no overdraft fees. Many online banks now do. So remember, overdraft fees are not just a small penalty. They can drain your money faster than you think. A little awareness goes a long way in keeping your hard-earned cash safe. ATM fees for withdrawing cash at another bank's machine. Another sneaky fee to watch out for is ATM fees. If you use an ATM that doesn't belong to your bank, you often get charged twice, once by your own bank and once by the ATM's bank. That $20 cash withdrawal? It could cost you $23 or even $25. So always look for your own bank's ATMs, or choose a bank that refunds out-of-network ATM fees. Transfer fees for moving your own money. Some banks even charge transfer fees, just for moving your own money between accounts. For example, sending money from your checking to savings, or wiring funds to another bank. It's your money, but they still take a cut. Tip: look for banks that offer free transfers. Now that you know the most common bank fees, let's wrap up with the main ways to protect yourself. 1. Always read the fine print before opening an account. 2. Don't be afraid to switch banks. Loyalty doesn't pay here. You should choose the bank, not the other way around. 3. Set up alerts in your mobile banking app. Many banks let you get a text if your balance drops below a certain point. That way, you don't get caught by surprise. Here's the truth. Banks make billions every year from customers who don't pay attention. Don't be one of them. Part 4. Online banks versus traditional banks. Now, the big debate. Should you use an online bank or a traditional one? Traditional banks. Physical branches. You can walk in and talk to a teller. Cash deposits are easy. Many people trust them because they've been around forever. Online banks usually offer higher interest rates on savings, fewer or no monthly fees, super convenient apps and online tools. But no physical branch. You can't just walk in and speak to someone. Here's the modern solution most smart people use: a mix of both. Checking account with a traditional bank for quick access and convenience. Savings account with an online bank to earn higher interest and pay fewer fees. That way, you get the best of both worlds. So, where should you keep your money? Your checking account is for daily life. Your savings account is for building your future. And the right bank is the one that protects your money, avoids fees, and works for you. Remember, money sitting in the wrong place is money that's slowly leaking away. But money sitting in the right place is money that grows and gives you freedom. In the next part of Financial Literacy from Scratch, we'll dive into a whole new side of money: credit, debt, and how to use it wisely. Until then, choose wisely, save smart, and keep your money working for you. See you in the next video.